Australia's economy is set for a rapid recovery. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from Yahoo Finance, because apparently our economy is set for a rapid recovery. Isn't that fantastic? Let's have a look at their take on this. So, and this is originally from Bloomberg. Australia's recovery is poised to accelerate as cashed-up households, joined by Victorians released from the lockdown, fueled a spending boom after the economy exited its first recession in 3 decades. GDP advanced 3.3% in the 3 months through to September, exceeding estimates as consumption surged by the most in the 60-year history of the report, the ABS said in Sydney on Wednesday. The rebound came after the economy contracted 7% in the second quarter. Now here's the thing, everyone. I suspect Australia is going to have a greater class and economic divide moving forward because of all of this. So much of the government's support and stimulus has been driven towards the housing sector, and housing literally, not apartments, housing. So that's going to exacerbate the divide between those who are in the property sector and those who aren't. The expansion occurred as Victoria State, representing a quarter of the economy, was shuttered to contain a renewed COVID-19 outbreak, and before the announcement of the additional fiscal monetary injection. Reserve Bank Governor-Chief Philip Lowe has made clear he's prepared to run the economy hotter than normal, given elevated unemployment and little risk from price pressures. The first step was to build the bridge to get us over the pandemic, Lowe said in Parliament testimony on Wednesday. We're coming down the other side of that. We're kind of ramping off the bridge, and now it's building the road to recovery. Well, at least the metaphor's changed. It's no longer a bridge to the future, it's a road to recovery. The report shows household spending surged 7.9%, adding 4 percentage points to GDP, and government spending rose 1.4%, contributing 0.3 percentage points. Net exports subtracted 1.9% from GDP, the largest detraction since the September quarter in 1980. The savings rate eased up 18.9% from an upwardly revised 22.1% in the second quarter, as government cash handouts and a dearth of spending options saw households repair their balance sheets. Compensation for employees rose 2.3% as hours works lifted, so labour pains. While the recovery is gaining traction, the outlook for employment, wages and inflation is more clouded. Unemployment stands at 7%, and the central bank expects it will still be at 6% 2 years from now. And apparently we're about to enter a housing boom, according to some, or at least a housing property price boom. I think we're going to get back to an unemployment rate of 4 point something to get the type of wage pressure that will deliver inflation outcomes consistently with 2.5, Lowe said. The RBA doesn't intend to raise interest rates until inflation is sustainably within the 2 to 3% target, and doesn't expect this to happen for at least 3 years. Now the problem is, their wage growth predictions from the RBA are pretty much useless, as you can see from this chart and their historical predictions. The resumption of growth brings an end to Australia's first technical recession, defined as 2 consecutive quarters of contraction in 28.5 years. Its record run included avoiding slumps during the 1997 Asian financial crisis, the dot-com bubble, and the 2008 global financial crisis. So what Bloomberg economists say? The rebound in third-quarter recovered around 40% of the decline in output from first half 2020. The continued easing of restrictions over the fourth quarter means the kick to growth from the normalization of activity will be a key driver of GDP outcomes in quarter 4 2020 and the first quarter of 2021. A recovery in private sector investment will be a key to sustained growth beyond that point. The RBA and government have worked closely to support the economy, with the bank last month enacting further stimulus that included reducing interest rates to 0.1% and initiating a $100 billion bond buying program over 6 months. Lowe said he had an open mind about whether he would extend the program. Essentially, well, the The potential there is now for unlimited QE here in Australia. There you go. As is required. And we just need to be aware that, here's the thing, with all of these purchases, how the money finds its way into the economy, where it gets into. And then you've got the candle-on effect, and you'll start to see bubbles forming. Australia has benefited during the pandemic from China's stimulus to revive its economy, which has fueled commodity prices. But ties have sharply worsened, and Beijing, which takes around 35% of Australian exports, has slapped tariffs on some imports, refuses to take calls from ministers in Canberra, and has gloated over alleged Australian war crimes. It's obvious the relationship is strained, Lowe said Wednesday. There are economic consequences, and we're still trying to work out how extensive they will be. It will depend upon whether these relationships remain strained or whether they're repaired. Still, with households cashed up and costs of borrowing low and COVID-19 contained, retailers are set for a bumper holiday period. Moreover, with international borders shut, tourism operators are set to boom. Really? As Australians usually spend more abroad than visitors do down under, meaning more cash will now be spent at home. Ah, okay. But is that going to make up for the shortfall in international tourism? There's the question. The RBA's central scenario is for the economy to grow 5% next year and then 4% over 2022. Recent medical breakthroughs give us some hope that things will work out better than this, Lowe said. If so, confidence would lift and there would be a further easing of restrictions. The result would be an upside surprise to growth and jobs, especially given the significant policy stimulus that is already in place. So there we have it, everyone. The predictions of now we're looking at 5% growth in 2021 and then 4% growth in 2022 for the RBA's central scenario. What do you think? Do you think we're going to start to see that growth? Do you expect it to happen? Well, are you planning to go on holiday in Australia? Were you planning to go overseas? But are you planning to spend in Australia? Have you loosened the purse strings, really? That's the question I should be putting to everyone. Have you loosened the purse strings yet? Or are you still holding tight, still concerned because we're entering a recession? I think it comes down to the individual about how concerned you are for your employment, how much money you have stashed away, how far ahead you are on your mortgage repayments. Those are the concerns. And as I said, I think we're going to be facing a K-shaped economy, even more so. You're going to have one part of the economy which is not going to feel a thing and another one which is going to push down. And the problem with this is it's going to lead to more social issues and more class separation here in Australia. Apparently we're an egalitarian society, but when it comes to property, that's the true indicator right there. What do you reckon? Do you think the 5% next year and 4% the year after is accurate? Can you see it happening? And how are you preparing to deal for all of this? As always, thanks for watching. Please like, share, and subscribe to the channel. Let me know your thoughts and opinions in the comments down below. If you're a fan and want to support the content I create, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy our merch from HeiseSays. You can use Gold Pass from the Perth Mint, or you can support us via PayPal. You can also use our AussieBroadband referral link if you each want to get $50 off the next bill. Take care, everyone, and I will see you all next time. Bye for now.